All right, thanks everyone for joining. My name's Sean Bailey. I'm the co-founder of OneFund Investments. I appreciate you all joining for the last webinar of the year that we're going to be doing. This one with Thompson Creek Wealth Advisors. So the co-host, Chris Taye, he just let me know that he's running into a small issue. He's likely going to be joining late. So for now, you guys are going to have to listen to me. So apologies for that. But we can get kicked off. And please, if at any point in the conversation you guys have any questions, feel free to drop them in the Q&A. We're going to save some time at the end of the webinar to chat through all of that stuff. This is the last webinar of the year that we're going to be doing. We did about 4 this year. I think they were a really great success. A lot of people have been joining multiple webinars. And so we're going to continue to do them next year and hopefully get a really great list of speakers set up. So we did about 4 this year. We're probably going to try to do closer to 6 or 8 over the course of the next 12 months. But without further ado, why don't we can get kicked off? And so the theme of the webinar today that we wanted to discuss is managing liquidity in alternative investments. And what we say when we talk about liquidity is we're talking about the ability to convert your investment in a private equity or venture capital fund into cash. You know, when you invest in public stocks, it's really easy to get liquidity. You can sell your stock at the push of a button and pretty much immediately turn it into cash. But liquidity is more limited when it comes to private markets. And there's a few reasons for that we can get into. But I'm going to quickly, and here's Chris Taye joining. Chris, we were just about to dive into liquidity and what it is and how it works around different asset classes. Before we dive into that, do you want to really quickly give an introduction on yourself?
Yeah, sure. And my apologies for that. I had a bit of an issue with my Zoom account and email. So, yeah, just to introduce myself. My name's Chris Taye. I'm a partner at an RIA called Thompson Creek Wealth Advisors, which we do, a fair amount of comprehensive sort of wealth management for clients, but mainly focus on investing, and the majority of the assets that we manage are in the what people would deem alternative investments, or mostly illiquid, a fairly large amount of illiquid investments. And yeah, that's mainly what I do on a day-to-day basis. And that's kind of a brief overview of myself.
Perfect. Thanks, Chris. And that's part of the reason why we were excited to talk with Chris about this topic, because he advises a lot of folks on managing their investments in sort of, less, I'll call it less than liquid investments. And so he's a really great person to speak to this topic. But I'll quickly share my screen and I'll kind of go back and forth between sharing and not sharing my screen. But I wanted to share a little bit of an overview to kind of help conceptualize liquidity when it comes to investments, because I think for most people who are invested in mainly cash or stocks and bonds, it can become a little tricky to think, okay, well, like what's more or less liquid? Cash and cash equivalents, so things like treasury bills or things like that, super liquid. Cash is like the definition of liquidity, right? It's already in its most liquid form. You can buy and sell things with cash. Stock's kind of the next thing over, slightly less liquid. It takes, today's day and age, seconds to sell, but it's still less liquid than cash. You can very easily turn them into cash. And then as we move further along the spectrum from most liquid assets to least liquid assets, you start to hit commodities, still fairly liquid, but a little bit less liquid depending on the type of commodities that you're dealing in. The least liquid asset that most Americans own is their home, right? Your home is a massive store of value, but if you wanted to sell it, convert that into cash, it could take months to do that. And then, on this kind of more simplified version, the least liquid asset that we're talking about is private equity and venture capital. And it can take years, 5+ years to get liquidity and actually start to get cash out of those investments. And so when we're thinking about how to actually get cash out of private equity and venture capital, you kind of first need to think about, well, what does the typical fund life cycle look like? So for most private equity or venture capital funds, they'll have a time frame of maybe 10 to 12 years. And most of your cash is locked up during the investment period, which is normally the first 4 to 6 years. So if you think about it, if you invest in a private equity or venture capital fund, you might not actually end up getting cash out of that fund for 5 or so years. And there are exceptions to the rules. On OneFund, we invested into a particular venture capital fund that they started to return dividends to their investors after only a year and a half in one of their predecessor funds. But that's sort of the exception to the rule rather than the rule itself. And the reason for this is that private markets where transactions move more slowly, and especially when it's run by a fund, is you need to wait until that fund has decided, hey, we actually are going to sell this asset now. Because one important thing to remember if you're investing in private equity or venture capital into funds is that the fund that you're investing in has discretion over what to do with the money. And there are some benefits and drawbacks to that we can get into. But one of the things to be aware of is that they have discretion over when liquidity occurs. And so basically you can imagine if you think about sort of the waterfall for money in and money out, if you're investing in a PE fund, the first few years you're going to be putting money in, you're going to be satisfying those capital calls. The next few years after that, the PE fund is kind of harvesting their investments. There's not really going to be any cash flows. And then, maybe starting year 6, year 7, year 8, you're going to start to get back those returns, assuming everything has gone well with the fund. And this is a bit of a trade-off that investors have to think. One of my favorite quotes by Solo, an economist I believe out of MIT, is that there's no perfect solutions, there's only trade-offs. And so the trade-off here is that from an academic perspective, by taking on less liquidity, you're actually getting a higher return. There's this concept called the illiquidity premium. And what that means is that investors, if they're going to be investing in a more illiquid asset, they're going to be expecting that illiquid asset is going to have a higher rate of return than a liquid asset. And you can kind of see that here on this chart to a certain extent, right? You have cash with the lowest rate of return. You're just going to be kind of getting interest rate. Stocks and bonds performing a bit better. Real estate, depending on how you count it, performing a bit better, especially with tax advantages typically. And then private equity and venture capital, which over the last 25 years has dramatically outperformed public markets. And part of the reason for that is this liquidity spectrum. Chris, I think it'd be good to chat a little bit about some of the potential benefits and drawbacks of illiquidity, but I'm curious if you have any thoughts to add on to that when it comes to liquidity among different asset types.
Yeah, I mean, I think back to, different asset types. There's like sometimes people, for instance, will compare, like real estate's a good example. It's one of my favorites. People will compare, they'll make a comparison of REITs, for instance, to something like non-traded real estate. There can definitely be benefits to either or. For instance, there's sometimes huge opportunities with REITs where you can buy real assets that are at a massive discount to most likely what you think or believe their intrinsic value is. But they can also trade at premiums, and there can, I think, also be challenges when you start to put, I like to call them kind of like you put liquid wrappers on illiquid assets. Like you're not buying and selling that piece of real estate or like the assets that they may own. And so that's something where I think people will make the comparison of saying, oh great, well yeah, you can just, some people have a much more of a preference towards liquid portfolios because they just feel they're safer. Like, well, I can just replicate the same kind of real estate exposure in a liquid portfolio using REITs. And I'm like, well, yes and no. And to your point you brought up earlier is from a tax perspective, you don't necessarily get that, but more importantly, just I don't think that that's that can be to your benefit or disadvantage sometimes. And then I think the next part that you were going to ask about was some of the drawbacks, and I definitely do think that illiquidity, I think what most people, when it becomes a negative for most people, is they over allocate into things thinking or assuming that hey, they look at say a prospectus or something for an investment, they're like, okay, this should have a 5-year life cycle. Well, sometimes it takes longer, and it could be to their benefit. Sometimes managers at a PE fund, they'll say, great, we can and sometimes managers take advantage of that, but sometimes they really they can get a much higher return by kind of pushing it out further. And I think that sometimes people they sort of put themselves in a bad position by over allocating into illiquid assets, and then I think one of the benefits that people can get is it kind of can protect them from themselves. In essence, if you're in a portfolio, they can more or less sometimes not being able to buy or sell something immediately because they're just having like a panicky kind of day like they might with traded things. It can be beneficial to not necessarily just, be able to press a button and sell something immediately, which that's I guess with any investment, but illiquid ones that's much harder to do if not possible in some cases. So I do think that in some cases it can be a bit of a protection for people on their own, but not always.
Yeah, it's interesting what you bring up about REITs and kind of this idea of taking an illiquid asset and putting a liquid wrapper around them. And a lot of times there's some research that shows that REITs kind of underperform holding the asset directly. And part of that I think has to do with the liquidity portion. It's also similar. I often hear a lot of folks say, hey, I don't want to invest in a private equity or venture capital fund directly, but I'll invest in maybe the public stock of that private equity or venture capital fund, right? So, you think like Blackstone, for example, or Apollo or Public, and you can go and invest in their stock, but you're not getting the same return profile in part because you're invested in actually a different entity, and kind of happy to go into that further if people are curious. But another part of that is that because the asset is more liquid, the price gets bid up a bit and your returns end up being brought down in many cases rather significantly. But on that topic, I think of kind of some of the benefits and drawbacks of illiquidity. We touched on a few of them already, right? And potential benefits, you get that illiquidity premium, which kind of enhances the return expectation. You talked about kind of forcing long-term holding and avoiding panic selling, and that's absolutely huge. I mean, most people if they end up losing money in the stock market, it's because they're buying and trading too much as opposed to buying and holding. But another thing that does is it gives managers a lot of flexibility in terms of value creation. If you're holding a company for 5, 6, 10 years, you have a lot more freedom to make long-term investments and long-term changes to the company, as opposed to if you're on kind of a quarterly reporting cycle. And like a public company, you really, really need to hit those next quarter numbers. In terms of the drawbacks, we talked a little bit about, it look like your capital is held up for 5+ years. And there's some ways that people are trying to come up with creative solutions to address that. There are some ways that we're coming up with solutions to address that. But ultimately, there's no free lunch. This all come at a cost. And something that's a big pet peeve of mine is when managers oversell the liquidity that you can get in their investments. It does introduce a little bit of complexity to rebalancing your portfolio, because when they are less liquid, you're a little bit more constrained on buying and selling. But another thing that I think is really important, and this is a drawback, but it's very addressable, is if you're making an investment that's quite illiquid, you really do need to do some rigorous upfront due diligence. This is part of the reason that I think retail investors have been excluded for so long from private equity and venture capital, despite the fact it's performed so well, is that you really do need to go in, analyze the fund, make sure you're comfortable with the investment, and do a lot more work than if you were just going to buy a public stock. At OneFund, we set up a marketplace. Our goal is to allow people to do that research themselves, but we also diligence all funds that go on the platform. And part of this is because we want to make sure that there are quality offers that are going in front of people. And you might look at 10 different funds, spend hours or days looking at each, and decide that those 10 funds aren't as good as you thought they were. And you really want to do that work, because if you get into a fund that you don't want to be into, you have limited ability to pull the money out. Flip side, though, is that you can, at least in my opinion, feel increasingly confident about an investment that you do decide to make. But ultimately, like when it comes down to like, okay, there are these benefits and these drawbacks to illiquidity. How does that actually present itself? And what I'm sharing here kind of returns across asset classes in alternatives. So kind of varying liquidity. And the main takeaway here is just that, over this 10-year period that was looked at in the data, over a 25-year period that Cambridge Associates looked at in their most recent report, private equity has just generally performed better on an IRR basis than other asset classes. like I said before, if you think back to that chart that I showed earlier in terms of what's most to least liquid, kind of have private equity, venture capital, then real estate. Well, you kind of start to see a little bit of that trend here, right? Where private equity is generally having the highest returns, then followed by real estate, with some of the other alternative asset classes performing still well over this period, but slightly lower. And not all of this is due to liquidity and illiquidity, right? There's a lot of unknowable factors in investing, a lot of secular tailwinds that can take place over the course of 5 years, 10 years, 20 years, or more that can change some of these factors. But generally speaking, these asset classes are performing roughly in line with their liquidity. And if you were to put public stocks on here, you likely, to a certain extent, continue to see that trend. And so, given all of this, this is one last chart that I kind of wanted to show, but given all of this, you might ask, well, like, okay, if PEVC performs so well, why don't institutional investors, ultra high net worth folks, invest all their assets into it? Part of it comes down to diversification, which is really the only free lunch in investing. But another part of it has to do with, just simply put, liquidity. You want to make sure that you're able to have assets should you need them in order to finance a new investment, in order to cover you if you lose your job, various things like that. Chris, I'm actually really curious, kind of in your world of advising folks, and especially advising folks around alternative investments, I would imagine a lot of the people that you're advising are kind of in the second, third, maybe fourth bucket over here, that like $1 million to $30 million net worth people who are kind of thinking about how to get more alternatives. I'm curious how you help them think through what the right allocation is to have to PE and VC, and what role, if any, liquidity plays in that.
Yes, that's it's a good question. I'd say that well, for our firm's a little bit weird because we kind of have gotten a lot of clients that look specifically for that. So people come to us looking to basically, to be honest, a lot of them, the typical thing is they own businesses, they understand businesses, and they're like, hey, they're kind of haven't understood stock markets and publicly traded things, because they're like, well, these don't actually look like they're performing great, but this is up a whole lot. But in terms of actually coming up with allocations that, I'd say that that's right within kind of the ballpark for them. Many of them, they don't, a lot of our investors don't have a huge problem taking on illiquidity, because for them, they're like, hey, if they feel like they understand it more, they're actually more comfortable with it, and they're not, very short-term focused, which I think is in all facets of investing, whether it's in public or private markets. I think that's one of the biggest issues that people make. And whether it's them or, if they're working with again, an advisor or manager or something, is they often overestimate their, their time frame, I guess, or tolerance for like a drawdown or something. But most often I find that people are, they'll say, hey, I'm a long-term investor. And then in, a year or two, they're going to be like, oh no, never mind, I need to go do this. So, I think that, for us, we generally see people within kind of that time frame, or sorry, that sort of, that basket is fairly accurate. I think that, I'd say a lot of our clients, for some of them, even go upwards of 20% into alternatives, but they're sort of, I guess, outliers. I think for most people, that would be someone like hey, they're very high income, fairly high net worth, person who owns a business, fairly young. They want to invest into a lot of different private things, so they have a pretty high appetite for things like venture and private equity, where one, they have the time horizon to kind of see those play out, and from a liquidity perspective, actually like realize those. Whereas, a good comparison would be someone who, say, like mid 30s, in a $5 to $10 million kind of portfolio, and they want to have a substantial portion into, PE, like VC, real estate, different kind of illiquid things, versus somebody with the same amount of money, but say they're retired and they're needing to actually draw down on their portfolio. You know, putting a huge percentage of their money, even though it could be higher returning, into something, for instance, like private equity or venture capital, putting the risks of how those actually perform aside with just the liquidity components, it's like you can't necessarily take on, they need to be able to draw down on their portfolio, especially if the rest of it does have some volatility in it. Um, putting them into say 20-30% of, a PE kind of VC allocation, probably doesn't make sense for them just because they don't really have, say they're like 65. Do they have the time, the time frame to really see an investment play out? And, to your point on kind of typical structures for funds, if you go kind of down into the weeds, you get into parts where um, funds can extend their investment periods. They can extend the overall like time frame of a fund. Some of that can be massively to the benefit of investors, but it can really, really draw like, something what you might think
Yeah.
might be 7 to 10 years can go way beyond way beyond that. And I think that's something that most people need to really sort of focus in on when they're looking at these kind of investments.
Yeah, it's one thing that we always say, right, which is you really shouldn't be putting any money into a private equity or venture capital fund that you think you're going to need in, the next 5 years or so. And me personally, when I take a look at my own portfolio, I am trying to hit that, call it, 15 to 20% allocation to alternatives. That endowments are kind of taking my lead from them as having much smarter people who work there than I am. But it's going to be different for every individual, right? And you kind of need to think through, what are you comfortable with as an investor? And it kind of starts to beg the question, right? Which is, okay, PEVC have these really fantastic returns, but also you have this question around liquidity. And so it starts to beg the question, are there any ways to get liquidity out of private equity and venture capital? And we've kind of talked a little bit about putting a veneer of liquidity around an illiquid asset and the effect that can have. But there are a couple of different ways that this has kind of worked its way through the financial markets, and there have been a couple different ways that have stuck. And so kind of talk through like one or two of those that stick out to me. The first is there is a limited secondary market, where investors can sometimes sell their interest to other investors between when a fund opens and when a fund closes. That market has grown, but it's still limited. And you're also constrained by what the private equity fund will allow you to do. Oftentimes, the private equity fund will say, hey, look, we don't want people to do this for various reasons. Sometimes the private equity fund itself will go out and do this with stakes in order to generate liquidity for LPs, but LPs don't really get a say in how that happens. There are some interesting fund structures that certain funds have put together called interval funds. And people here may be more or less familiar with them. Were growing in popularity, in my opinion, in this market a few years ago, and it seems like they've sort of tamed down with the fall of or kind of the shuttering of one or two funds that were doing this. But an interval fund is basically a kind of semi-liquid fund where it has redemption periods. So each quarter you can sell your stake during like a 1 or 2 week window. So the benefit of this obviously is that, hey, 4 times a year, once a quarter, you can sell a certain amount of your equity in a position. The downside of this is that a lot of fund managers that I talk to, I think, are vastly overstating the effectiveness of interval funds. Typically, you are only allowed to sell a certain portion of your investment, and it can take almost 4 years sometimes, depending on the constraints that a fund puts on, to fully exit your position. This is like kind of almost like defeats the purpose. It's kind of comical. Like if you're trying to exit your position in a private equity or venture capital fund, like you don't want to do it over the course of 4 years, right? Like you want to do it now. And so a lot of these funds that I think offer like false hope on the liquidity front. An area that I think is a bit more appealing, but still has its drawbacks, is just simply selling your stake in a private equity fund to another LP in that fund. This is actually something that we did at OneFund in order to get access to a really great venture capital fund. There was an LP who was, heavily involved in, I believe it was in crypto. The investment, they wanted to get some liquidity out to help rebalance their portfolio, and basically they wanted to exit the stake in the GP. We were able to work out a deal with them where we took their stake in the GP and offered it to our members. And it's just kind of a win-win for everyone, right? We got a stake in a really great VC fund. This LP got the ability to exit their position. This is almost one of the, it's like you kind of have to have lightning strike twice in order for this to work. But I do think there's some promising potential to set up marketplaces amongst LPs within the fund, where you can go and sell your stake. And granted, this would likely happen at a discount. And I think that's really the main story here, right? If you're looking to get liquidity in a PE or VC fund, there's no free lunch. You do have to take into account what the drawbacks are, whether it's an interval fund and you're going to be limited on how quickly you can achieve liquidity, or whether you're buying a stake from another LP and you might have to sell your stake at a discount in order to get that. But I do want to kind of, Chris, I want to hand it over to you a little bit to talk a little bit more about portfolio construction, but I do just want to share one slide to kind of tee you up, because this is honestly one of my favorite charts that I've seen, because I think it just highlights really, really well why we're doing what we're doing here at OneFund. And what this chart is showing, if people have come on our previous webinars, you've definitely seen this before, because I'm obsessed with this chart and I show it all the time. But this is talking about the benefit of a multi-asset portfolio and the benefit of incorporating in alternatives, whether they're private equity or distressed debt or private real estate, into your portfolio. So what you're seeing here is all of these different dark blue dots are traditional assets that probably most people on this call have in their portfolio. US equities, international equities, maybe some high grade bonds. And it's showing what the risk return profile of that portfolio might look like. So this data from Fidelity shows that from 2005 to 2021, your risk return profile would be this light gray line. But then when you add in alternative assets into the equation, these light blue bubbles, you add in private equity, you add in venture capital, you're actually able to move that frontier outward, that risk adjusted return. And so for the same unit of risk, you're able to get a higher return through diversification. Diversification, like I said before, it's really the only free lunch when it comes to finance. And it's part of the thing that makes us very excited about what we do. But Chris, I wanted to kind of close on this because I think it leads in a little bit to the conversation that you wanted to have a little bit about portfolio construction and how to actually think through that and incorporating alternatives. But I'll hand it over to you for a few minutes and then we can dive into the Q&A.
Yeah, no, so so from a portfolio construction standpoint, I'll just use an example that we've had quite a few times is we have we have some larger clients. I'd say they're much more in your kind of the probably more like family office types that we might manage like a sleeve of their portfolio, and they'll say, hey, great, I have a big lump of liquidity, or they'll have a liquidity event, or they'll say, hey, I want to allocate this stuff. I want to be kind of all in some form of alternatives or uncorrelated things. I'm fine with being illiquid, but they'll say that, and the next question is like, okay, well, what portion of that do you really, like what's the amount that you need to be able to access over sort of different time frames? Is kind of like, I think one way that you can approach it and say, look, like next 6 months, 1 year, 3 years, and ultimately like what portion of it are you completely fine with not seeing after like a, pretend you don't see any dollar back that you put into it after 5 years, is definitely one way to approach it, because I think and so that's I think one way to kind of how we might start looking at something, as we kind of look at different investments, taking into account whether or not they are a call kind of structure or not. Because if you go ahead and allocate into funds that are doing capital call, it's a drawdown fund, right? One, you need a place to actually be able to. You need to actually have a plan to put the money while you're waiting for it to be drawn down. And sometimes funds will be like, hey, we're you might time something with a fund where they might be getting close to like winding down their investment period and doing like a final close, at which point it's kind of easier to know like when you're going to get drawn, because it's kind of like, what have you called already? You'll pay some kind of true up, which is basically like the preferred return that's been accrued, plus the amount that you'd have to call. And so it's easier to see when that's going to happen. But sometimes, you might commit to a fund and it might take, they might plan on drawing it all down in a year and it takes almost 2 years to do that. And so managing the portion of their portfolio where one, you're committed, like your investor as an LP, you're committed to it legally to invest, right? And managing what you do with the money in the interim, I think is one can be challenging because you don't want to put it into something that's really volatile. Now it's kind of a different story because you actually get paid for having cash, and rates on, very like, T-bills and stuff can actually pay you something, whereas before they really didn't do anything. Um, it's that's a consideration that I think sometimes people overlook, and I think that you're kind of seeing some of that now, is where, I've talked to a number of managers where they said, "Oh yeah, great, we, had investors committed, but X, Y, and Z person, they don't know if they can meet their capital call." And I've like talked to, managers on the GP side that have said, "Hey, if you know somebody that would want to take some part of somebody's commitment because they can't really come in for the full amount, that's something I think you really need to take into consideration when you're kind of putting together a portfolio of these things." And also paying attention to, kind of what we talked about with sort of the kind of like veneer of liquidity with some structures like interval funds and stuff. I think, where I think people make the mistake of doing that, and whether it's, hey, they get shown something by a manager they shouldn't have been, and kind of, made it seem a lot more liquid than it is. As someone, I think, on the LP side, you need to be really mindful of what you actually look at, what that actual portfolio is and what it's investing in. Because I think sometimes people will say, great, well, we can do this whole sort of alternative allocation. As we need to draw down stuff, we'll just redeem out each quarter, from, say something that's more liquid, and it might be, okay, great, you're gated and you can only redeem 5% of that. And to your point, it could take 4 years to draw that down, at which point you're short on meeting capital calls for other components. But then also taking into account, things that could have to do with, recycling within a portfolio. Sometimes, some funds can recycle, the proceeds that they might have from investments, which can be good and bad for the portfolio, but some of us people don't realize that. Taking into account also distributions where, a fund might be having fairly strong distributions, but there might be, markets might take a bit of a downturn. And when I say markets, just might mean that, like, hey, the business might, not be able, they might have some interruptions from a cash flow perspective. And so if you're trying to kind of, manage taking distributions from one fund or one type of investment and expecting to be able to have liquidity coming out of that to be able to meet capital calls for another, while that can seem really great on something like a spreadsheet, and you're like, okay, great, I can definitely do this. Really being mindful of like how you manage around doing that in reality, where one, if there's just an instance where those cash flows don't exactly come out when you expect to, the timing of things gets pushed out. And sometimes, people will look at, they'll have one fund, for instance, that, you might have an allocation to a PE fund and it's kind of coming down to like the end of its life cycle. And, you know, you're expecting it to be wound down by the kind of like the end of the year. And you're like, okay, great. We should have, all the capital should come back by now. And then in reality, it's like, hey, you get to, maybe a month within that. And what happens is it's like, okay, great. Never mind the, purchaser of the assets or something, like, hey, it's going to be pushed out a couple months, and somebody's already committed into something else. And you're like, what do I do now? And that can present a challenge. And then I think, the other thing that sometimes I think people vastly can kind of overlook, and I think I don't know if I'd say managers do it on purpose, but it's definitely something to be mindful of, is um, not only looking at like what lockups are in funds, if they are something like an evergreen fund or something like that, but also paying attention to notice periods that you need for redemption. Um, I do think that that's something people don't really pay attention to as much, where, if you says, hey, we do semi-annual redemptions with, 180 days notice. Well, if you catch that in between quarters, that notice period might be pushed out much further than you actually think. It's not like, okay, great, in 6 months, I can go ahead and access this. So I think that those are, things I'd say to just keep in mind when you're trying to put together a portfolio, to kind of manage around those things, and things that, you should really try to pay attention to. And I don't know if I answered your question exactly. So if you want me to touch on any more of those points anymore, I'm happy to. But I think those are some things I would, definitely try to pay attention to.
No, I think it's good, and you did answer the question a bit. And part of why we wanted to do this together was just to kind of hear your unfiltered thoughts on it from advising a lot of people about this sort of stuff. I think ultimately, like, one of the big things is just, hey, at the end of the day, these alternative assets are great as part of a portfolio, but you really need to understand like what you're investing in, and liquidity is a big component of that, because alternative assets do just differ fundamentally from public equities and public bonds, especially when it comes to liquidity and return profile. And so it's really helpful for thinking about it from that perspective. Maybe now is a good time. One or two questions came through on the Q&A. And then also in the meantime, I just launched a quick poll. And so we'll go through and answer a couple of the questions that came through. But, with the few minutes that we have left, I think we could ask, if there's anything else related to PEVC that folks would like to double click on, whether it's, what PE and VC return breakdowns, different types of private equity funds, institutional allocations to alternatives, impact funds, et cetera. So folks can take a moment and take a vote on that. And in the meantime, I'll jump into a couple of the questions of the Q&A. One question that we got through is, how readily do funds agree to investors seeking liquidity? I think it's a good question. And like we talked about, you are limited in liquidity contractually when you sign many of these agreements. And so the main thing that I would say on that front is that GPs, PE and VC funds ultimately are going to want to work with you, right? It is a complete mess for them if one of their LPs defaults or isn't able to pay a capital call. So I think you have more power to transfer your agreement when you're in the capital call period. And that is the period when the fund is actively investing. And when they find a new investment they're going to make, they reach out to all their LPs, all their investors, and they say, hey, you need to wire us X amount of money. And it's because if an LP misses their capital call, the fund, it's just difficult for them from an accounting perspective. And so they're actually they're not going to be happy about it, and you might not get invited to participate in their next fund. But they're usually going to try to work with you because it's in everybody's best interest. And like I said before, I have direct experience with this, working with a fund where there was an LP who wanted to get out, and we as OneFund were able to step in and backfill them and get access to a really, really cool fund. And so they're typically willing to work with you in that period. After the investment period's over, to be honest, they might just tell you to go pound sand, and just you kind of have to deal with it. It's going to depend a little bit on your relationship with the manager, but if you're able to address it in the first few years, they'll usually try to find a way to work with you. The other question in the Q&A was, what advice would you give limited partners seeking to negotiate better liquidity terms up front when committing to a new fund? So the one thing that I'd say is, ideally, you not in a position where you feel like you're going to want to negotiate liquidity. Like I said before, you really shouldn't be investing money into a PE or VC fund that you feel like you're going to need, in the next 5 years or so. And I think the rest is really going to depend on your size. If you're going to be an anchor LP in the fund and, take up 5, 10, 20% of the capital that the fund's going to be raising, you're going to have a lot more power to negotiate there. It also might be harder for you to transfer your liquidity out, right? Because I'm curious your position with some of the customer or some of the clients that you've advised. Have any of them seek to better negotiate liquidity in kind of the upfront terms, and have they had any success there?
I've definitely had them ask, and to be honest, like my main sort of my initial response before even asking the manager or like discussing it with them is sort of like, hey, if you really want that kind of liquidity, maybe why don't we just either size it down? We had one that wanted to, really was fairly gung-ho about wanting to anchor like a real estate kind of private equity portfolio. And they wanted, one of the things they wanted was kind of a liquidity thing. And the manager that they were talking to, one was not in a position where they were, having an issue raising any money, which is something that I think is worth discussing after this. But like, ultimately it's kind of just like, why? What's the point? Because if you're gonna want liquidity out of this, why don't you just size this down, or maybe not even do it if you really need the liquidity, because it's kind of defeating the purpose of it. And if they feel like that makes them, be in some position that's good, what I'd say, LPs should consider is that if you're talking to a GP that is willing to give somebody those kind of terms, even if they're anchoring it, it puts the GP in somewhat of a bad spot, but it can also like negatively impact every single person, because if a GP gives that ability to an anchor that's say like 60% of the portfolio, and they have to go sell something, and I mean, the underlying investment can be performing great, but if they're forced to fire sale it and it's just not something that's super liquid because they contractually agreed to it because they wanted to, it'd be a lot easier for them to raise money. It puts all the other LPs at risk of, actually kind of making less money on that than they should have. And that's something I would say, like, I would be more from the LP perspective. I'd say, like, for my clients, it's like, well, then why are we talking about doing this in the size that you want to? And it may not make sense, and more so trying to just avoid that altogether. If you're talking to a fund and they have an investor like that, I would really try to understand sort of what the relationship there is and why, and take into consideration that like it could end up, well, right now it doesn't seem like an issue. It could be negatively impactful on the entire portfolio and all the other investors.
Yeah, I couldn't agree more, right? If you feel like you need to negotiate liquidity up front, downsizing the investment is honestly probably the way to go. And also, with the new rules that the SEC released a couple months ago, LP funds aren't allowed to give LPs certain provisions that could negatively impact other investors in the fund. And so if something were to arise with liquidity where it would then adversely impact how expenses were shared, things like that, they're actually not able to do that without giving that option to everyone. And so that might limit their willingness to do this sort of stuff, which I think in many ways, increases the importance of trying to institutionalize some of these liquidity offerings through things like marketplaces. So it's kind of funny, the poll that we let out on what people want to talk about, every one of the options was in like the 10 to 20% range, except for current fundraising environment, which was at about 90% of the votes, or individuals who voted said that they wanted to chat about that. So the current fundraising environment is pretty interesting. I will share another slide. Apologies, I used to be a consultant before this, or before working in private equity. I was a consultant, and you can take me out of the consulting firm, but I guess you can't take the consultant out of me. And so I tend to think of everything in slides. So I'll share a quick piece of data. I just have a massive deck with a lot of different slides in it, but here we go. So what we've seen in kind of the fundraising environment over the last couple of years has been what we'll call a flight to quality. The title of the slide might be a little bit too grandiose. It's really kind of a flight to brand or a flight to size. Whereas in the last, the 10 years before the pandemic, there were a ton of like small VC funds popping up that were raising, 10, 50, 100, $200 million funds. And a lot of capital flowed into those funds. And what we're seeing over the last few years is with kind of the economic uncertainty, capital is flowing towards much larger funds, kind of your 1 billion plus size fund. But for the first time in the last 20 years, we see that roughly 70% of funds raised have gone to funds with an AUM over $1 billion. And so people are kind of reverting to scale. They're kind of placing their money on funds that are quite large with the hope that, hey, this will probably be more stable. And so this chart on the right is just showing, the darker the band, basically, the larger the AUM, and the bigger the band at any given point in time, the larger share of funds raised are going to that type of private equity fund. And so what you're really seeing is a big uptick in the amount of funds raised by funds that have over 10 billion in AUM, 5 to 10 billion in AUM, a billion plus in AUM. And you're seeing a really big decline in the share of funds, really kind of over the last 10 years, a rather steady decline that's gotten steeper of funds that have under $250 million in AUM. So how have we kind of been thinking about this? Number one, it means that fewer private equity and venture capital funds are going to be able to raise their next round, especially smaller funds. And we're even seeing it with larger funds. There have been a couple really big GPs like Carlyle or Insight that have had to downsize their funds. And those are huge multi-billion dollar managers. I think this is going to create a lot of opportunity going forward. Like, I would hate to be invested in like the 2021 vintage for a lot of these GPs. Being in the 2023 vintage, I think is going to be really appealing. As the capital raise declines, you're going to have fewer funds that survive that are able to deploy capital. And ideally, they're going to be chasing a pretty similar set of opportunities going forward, especially on the emerging manager side. Those emerging managers that have under $250 million in AUM, they're just, to be honest, they're getting slaughtered right now trying to fundraise. If they're not showing that they have, in their historical funds, delivered real alpha and delivered real dividends to their investors, from what we've seen, they're just having a really hard time raising. And on OneFund, we kind of have our pick of the litter, especially when it comes to really early stage managers. We see a ton of them and we invest in very few of them. But the ones that we do invest in, you feel high conviction on. And I personally think that given the fact that so much money is flowing to these larger managers right now, these smaller managers, these early stage managers are having a lot of trouble. I personally like to zig when everybody else zags. So, but that's a little bit of what we're seeing in the fundraising market right now and what some of the implications actually look like for LPs on the ground. But it was really fantastic to have the conversation, Chris. I thought it was really interesting talking about liquidity, and it was great to kind of engage with some of the folks on the call. Chris, I don't know if you have any closing thoughts or remarks that you want to impart on folks as they're thinking about private equity and liquidity in general.
No, not. I feel like I probably said everything I could have summed up. But no, I really enjoyed it. Always interesting discussions. There's a whole lot of questions I could, or a lot of interesting things. I think really, some of the things we talked about and something that I think would be an interesting topic for people would be talking about the secondary market more because,
yeah,
kind of to your point, I do think that's an interesting space. I think it will be really interesting when you just mentioned like 2021 vintage funds versus 2023 ones. There are a number of different, some of them are kind of like marketplaces, some of them are dedicated funds that are buying up secondary positions from people in older vintage funds at like some of them pretty big discounts, which is different than if you were buying in at the par value of them. But the whole secondary space and sort of the growth of kind of these like marketplaces for secondaries for like LPs to kind of make their own kind of LP to LP or LP to new investor kind of transactions or dedicated funds for that, and sort of where that's kind of going, I think is a whole space. It's like probably warrants an entire call to do, but that's something that I think is really interesting. And definitely something that I think people should keep in mind if they find themselves in a space where they do not think there's any liquidity. Always you can ask managers and say, hey, can I try to get, like, if I find somebody else who wants to buy this from me, would you guys approve a transfer? The only time I've ever had that be an issue is like, or really like one of the main questions is sometimes like, who is it? Because sometimes they don't want a competing firm to like solicit they don't want necessarily someone to know exactly what's going on in their portfolio. But to be honest, if it's between like other high net worths to other high net worths, I don't think they typically care because they don't, like, to your point, they don't want like an LP that's stuck in a position where they can't fund it. It can have a whole lot of negative implications. So that's something where I think one of the things people I think often don't even try to do is they don't even try to approach the GPs to ask. I think they're just like, oh, hey, I don't have the money. Okay, well, try to find a solution for it. And you're definitely, to your point, there's no free lunch. You're probably going to take a hit on the actual, you're going to get a discounted value for it, but it's an option and it can be something that you should consider if you need to.
Yeah, 100% openness and transparency with GPs is always important and valued. But yeah, thanks so much again to everyone who joined. We'll send out a recording of the webinar in the next few days, and we really enjoyed it. Thanks, everyone. Have a great rest of the afternoon. And thank you, Chris.
Yep. Hey, thanks.